Hello and welcome to the week ahead for the week starting Monday, the 23rd of March. As we roll on, of course, the focus continues to be on Iran, and that will remain the case. Alongside that, this week we have inflation data coming out of the UK and Australia in particular. So let's focus on those three themes as we try to gauge exactly how to play the markets right now. So first and foremost, we have the overview as ever, according to Trading Economics, and you can see inflation data kicks off on Monday with the Japanese CPI figure expected to drop down to 1.3%. Then on Tuesday, manufacturing PMIs out of Germany really kicks off a day of PMI figures, even though they're not all highlighted here. We have a whole raft of them across the globe. Wednesday, we then see inflation data coming out of the UK. We also see the Australian inflation figure coming out, but that's not on this graph. And then we have data out of Germany, business climate, consumer confidence. Particular focus will be on those, given everything that's happening right now. And you can see the collapse in consumer confidence expected, in particular down to minus 28 expected. Then on Friday, we've got more from the UK. So it is a week that we are largely devoid of anything particularly notable out of the US, but it doesn't necessarily mean it's not going to be an interesting week, because we continue to see everything that's happening out in Iran really influencing market sentiment. So we're going to kick off in terms of the economic calendar, at least, with the UK. You can see there's a whole raft of data coming out over the course of the week. PMI numbers on Tuesday, inflation on Wednesday, and then on Friday, the retail sales numbers. Coming off the back of the PPI reading out of the US, it was at 0.7%, so much higher than markets had anticipated. The inflation report out of the UK will increasingly become interesting from a sort of wider spectrum, because in the past, people only really cared about the CPI numbers. But then when you start to see a sharp surge in terms of gas prices, particularly European gas prices, that's expected to feed into consumers and producers. And therefore, the likes of the PPI input figures will start to look more interesting than they have done in the past. So keep an eye out for this inflation report. Right now, we're not necessarily expecting too much because of the fact that we've got the data coming out for February, but nonetheless, as we see this downward trajectory in terms of UK CPI, which is expected to come in at 2.9%, do we really care about that, or are we only really caring about high inflation numbers? And I think that's likely to be the case. If we see elevated CPI numbers, then people are going to think, wow, that's even before we really saw the inflation coming from the Middle East and the energy inflation. Therefore, a more sort of hawkish tone, a stronger pound potentially coming into play. And you can see here that the expectation all year had been for a massive collapse in UK inflation around this time of the year. When the April figure drops out, we're expecting to drop even down to potentially 1%. And around that kind of area, well, things are certainly changing in a notable way. And you can see here in terms of expectations for UK rates going forward, instead of rate cuts, it's all about rate hikes. And you can see here that there's a possibility that we could see a rate hike by the end of the year. And certainly the bond markets are really signaling that similar kind of theme in terms of fear around hikes coming into play, rather than people thinking we're on the cusp of a rate cut. Now, notably, the FOMC meeting that we've just seen recently did point towards, in the dot plot, one cut for the remainder of this year and then one more cut next year. Well, even that might be too optimistic. So we're seeing a notable shift. And so let's look first and foremost at euro sterling. I think this is an interesting one because of the fact that we had already seen the likes of the ECB essentially done with their process of easing. And therefore, it was really down to the UK. And so we were signaling the idea that we're going to see a sort of stronger pound coming in, a stronger euro, a weaker pound coming into play as the UK moves towards easing, as that inflation data comes off. Well, that regaining of ground that we have been seeing, and this strength that we've been seeing over the course of the past year, well, that has changed significantly, because now we're looking at the potential for a topping pattern. If the UK in particular, which really has its own problems when it comes to the storage and the pricing of gas, if we suddenly see a major surge in terms of inflation, that is the kind of thing that could really lead to a turnaround here. And so you're seeing the possibility of that with this head and shoulders formation following that strength that we've seen throughout, in particular, the first half of last year. And so keep a close eye out for this support level that we have here, 0.861. At the moment, we've sort of dropped back into it and we're sort of regaining a bit of ground. But if we break below that level, and in particular, if we see sort of hot inflation data out the UK, then we could see a reversal of much of those gains that we've been watching over the course of 2025. So certainly something that I've been talking to you guys about over the course of the past year, but that narrative potentially changing as we see the inflation data signaling, instead of rate cuts, the possibility of rate hikes from the Bank of England. Then next up, we're going to look in terms of Australia. Now, they have the sort of other side of the coin, and that is because they've already got an inflation problem. And so this is just going to pile more pressure on that. Now, we've just seen a rate hike from the RBA, taking them just 25 basis points away from the height, that the previous peak that we'd seen in terms of Australian interest rates. That's 4.1%. So where do we go from here? Well, we have got inflation data coming out. Once again, it is for February, so it's worthwhile bearing that in mind. It doesn't take into account any near-term price movements and any moves in terms of energy. But certainly, again, if it comes in hot this time, then people are going to think, wow, if it's coming in hot now, what's it going to be like when we see the major adjustment coming into play around the energy price moves? But of course, caveat is we don't know how long the moves are going to happen for, because we don't know how long the war is going to wage on for. But certainly, as things stand, the damage we're seeing means that it's going to be a prolonged period. Even if we see a resolution tomorrow, I don't think that the energy markets go back to normal instantaneously. So inflation does seem likely to come around the corner. In terms of the sort of inflation for Australia, you can see here it's the top of the pile of these countries, 3.8%. And so if we see further upside for Australian inflation, could that point towards additional hikes? Possibly. But when we're looking at the likes of the Aussie dollar, which has already been in a strong position, much like euro sterling, you've got the possibility of a sort of bounce back for some of those other areas if they suddenly start to see a surge in terms of price pressures. So that's worth bearing in mind. As things stand, markets are expecting another hike coming into play at the next meeting in May, in actual fact. And then beyond that, there's the possibility of another one by year end. So a couple of rate hikes more for the RBA before the end of the year is certainly a possibility, according to market pricing right now. And if you look at the likes of the Aussie against the Kiwi, which again is a really interesting chart that I've been showing you guys for a while now. You can see here on the weekly time frame, it's been an incredible outperformer over the course of the past half a year, 9 months, something like that. So this is the weekly time frame. It's just going up and up and up and up and up, right? So it's a great trend, and it does still continue. We've seen the RBA hike, and we're still seeing the creation of higher highs and higher lows. So you just follow that pattern, really. And so, yes, if we see hot Australian inflation data, it sort of feeds into that narrative once again and points towards a possibility of further upside for the Aussie dollar against the Kiwi. But the caveat here is if we start to see the New Zealand dollar, so the RBNZ, moving into a period where they're going to start hiking, then maybe we see this narrative shift. But really, it's a case of just following it on the near-term basis. And as things stand, that trend that's been so consistent looks like it's going to continue apace as we go forward. And finally, we can't really end things without talking about what's happening in Iran. And this is absolutely massive right now. Basically, the Israelis struck a LNG plant over in Iran, teaching them a lesson. Well, they retaliated by hitting a plant that is essentially part of the same structure. And they are two of the biggest in the world. The Ras Laffan out of Qatar is the biggest LNG plant in the world. And this is hugely problematic, depending on where you're asking, right? Might not necessarily be that problematic for a country that maybe doesn't rely on them or has a huge amount of stockpiles. But for the likes of Europe in particular, this is hugely problematic because they are heavily reliant on imports, number one, and they don't necessarily have a huge amount of stockpiles. Number two, you've got question marks about whether the US is going to essentially shut off exports to make it so that they have their own supply, and they don't necessarily see that major rise in terms of prices of oil and gas. Maybe that happens. So it could be a big problem for Europe, but certainly each week different things are happening. So whether it's gas this week and oil next week, or helium the week after that, or fertilizer, it's all sort of playing out as we move forward. The end doesn't seem to be in sight at the moment. But as you can see here, essentially you've got the biggest LNG plants. I say largest oil fields, these are gas fields. So this is the biggest two essentially being hit here. And you can see in terms of the size of them, they're just absolutely huge. So that is a massive deal. It's inflamed the problem massively, and it's really led to significant downside for equity markets. It's really sort of dialed up all of the narrative that had been building, and it's just made things 10 times worse. And it's essentially the Israelis that are doing it, because the US are pretty much saying, well, we wouldn't want them to do it again, and I've told them I don't want them to do it again. So Trump's not looking particularly strong at the moment. The Israelis doing essentially what they want, and what they want isn't necessarily good for the markets and the global economy, which is what Trump cares about. And they don't care about that. They care about their own security and essentially changing the narrative and the security situation in the region. So you've got two sides that are essentially not aligned. One is doing what the other one doesn't want them to do. And you'd think Trump in the past has been very strong, and, you know, particularly against with his allies, you know, not essentially listening to them. He'll just do what he wants. Well, on this occasion, he's looking very weak. And essentially, even if he decides to call an end to the war, I think the Israelis will probably carry on bombing targets in Iran. They've said that they've got thousands more targets to hit. So, yeah, the longer this goes on, the more problematic it's going to be for markets. And even after that, the aftermath, you're going to be looking at data and saying, how's this impacted growth? How's this impacted inflation for many months to come? And then we're looking at how these oil and gas fields can potentially come back up and start running at some sort of semblance of normality. Here's that tweet or, well, post from Trump. And he's essentially saying that, you know, okay, granted, Israel's hit the South Pars field in Iran, but they only hit a small section, and it wasn't Qatar. They weren't involved, but now they've hit this Qatari LNG plant. No more attacks will be made by Israel. So he's trying to put his foot down. This could be beneficial in terms of possibly drawing a line under attacks on energy infrastructure, but that doesn't necessarily mean that the Iranians aren't going to do that, because they have seen that they've been getting great success, and they've already said in the past that they think they can get $200 crude and alike. And with that in mind, let's just finish things off by looking at things from the perspective of crude. So let's just get rid of some of these. I've got everything on here, which, as I've shown you recently, everything is all sort of tied together at the moment, being led by energy markets. But you can see here that the rise taking us back up towards that sort of 114 mark. So this is Brent crude, and bear in mind there's a major differential between Brent and WTI. WTI being held back a bit, Brent crude more focused on the Middle East and North Sea, but also there's question marks about whether we've got the likes of Scott Bessent and the Treasury actually trying to sort of intervene in the paper markets to keep prices relatively low on the WTI front. Nonetheless, over the near term, you can see here that we've got this very clear uptrend. We're going to see major spikes, and bear in mind, over the course of each weekend, we see something major happening. And so I wouldn't be surprised to see something major happen again this weekend. So the weekends do have the possibility of major volatility at the moment. You're seeing gaps pretty regularly at the moment. So it's a very volatile market to be trading. You can see here where it all kicked off. And then we saw that massive spike here where we saw the targeting of oil and gas facilities. This week, we didn't necessarily see a major gap. Nonetheless, I'd be very aware of the possibility that that happens. But keep an eye out for this. This is going to be absolutely key. Sentiment at the moment being driven by this. So we've got the 2-year, so where a rate's expected to go. We've got the US dollar. So that has been following oil prices. Then we've got the inverse for gold and for equities. So where oil and gas goes, the rest will follow. It's negative for equities. It's negative for gold and silver, but it's positive for Treasury yields and for the US dollar. And as things stand, it looks likely we're just going to see a continuation of this until we see some sort of move to bring an end to this conflict, which right now we're not necessarily seeing. So this is the key topic. And certainly if we see continued strikes on oil and gas facilities, then it's only going to get worse. But right now, people think that oil prices are massively undervalued, considering what's happening in the world right now and the destruction of facilities that mean that we're going to have future problems to come as well. That's all for today. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great week ahead.